I know that's a little bit, again, a little bit esoteric of a concept. Think about this. Prior to the announcement, the option market maker only had historical volatility to use, right? That's all he ever has. Yet it's up to him to kind of create and kind of cogitate, if you will, a little bit on the implied volatility. If, in fact, he thinks the stock's going to go up in value, people could buy options and he could be left with the short end of the stick. So what will he do? He will actually make those options more expensive by pricing in more volatility into the cost of the options. It's kind of like a balloon. If you imagine a balloon, right before the announcement, the balloon's kind of flat. Maybe it has, a breath or two in it, okay? The balloon's just a little kind of deflated there. Then all of a sudden, we see the announcement. Prior to the announcement, since the market maker has an inkling that this is going to happen, the market maker goes, all of a sudden we have a big, huge balloon filled with volatility. And if you don't understand this concept, you buy it. Is it expensive? Yes or no? Compared to its historical? Yes or no? Class, what do you think? Yeah. Then the stock goes up. The stock moves up a little bit, but now you still have all this volatility. And then, since the market maker knows the stock's going to come back down to life, that huge balloon goes, comes back down to normal. You have then bought an overpriced option because the market maker priced in what was going to happen. Does that make logical sense? Well, the same thing happens in dividends. Have you ever heard of dividends? I hope so. When we know a dividend is about to come out, maybe a stock performs a certain way. Sometimes stocks go up, down, whatever it may be. Just let's say a stock would traditionally rise up to their ex-dividend date prior to announcing or distributing a dividend. Well, therefore, since we know that that's a set date, there's the ex-dividend date, the option market maker will go ahead and make those options expensive, make you buy expensive options. If you didn't have our calculators, you would be buying these. Thankfully, because of our website, you won't be tempted to buy these expensive options, but that's how he pulls in people without education. That's how people say, oh, you can lose your money. They don't know what I'm teaching. They buy fluff. It's also called fluff. We used to call it jack or fluff or just nothing. It's air. It's nothing. It's volatility. All right? So you don't buy expensive options, all right? So that's just I know it's a little bit of an insight there, but that's what they would do. That's what I was taught down in the CBOE, going down there and kind of learning from these mentors. And we have these huge screens all over. I mean, I can't remember the amount of wire that's in that room. I think it's like, 3,200 miles or just not exact. I mean, just obscene. And and they say, how do they do these things? How can you keep in touch with thousands of option contracts going on all the time? I mean, how do you do it? And he taught it all. It's all the kind of the basic things we're teaching here. And he uses his option Greeks and he prices the option so he's covered. So that if something happens, he's covered himself, and he uses volatility. He also uses the gamma, the theta, the rho, and the vega to help him out. That's a little bit more advanced. But the volatility, that kind of makes sense. He makes those options more expensive. All right. So then the stock is up. The stock then retraces a little bit down to its upward trend, maybe its 30-day moving average. And we know for a fact that in the future we have a split date. We don't know when it is, we know when it is. And we know that the stock very well may rise up until, if you take a look right over there, whammo, there's your split date. Now, everything's let out of the bag. The stock is then split. So let's say, the 100, I can't remember when it split, but I think the stock that I was trading at 130, I can't remember the exact price it split down about, $40 or $42, whatever it was, And then oftentimes the stock, in this case it didn't happen, but oftentimes the stock will have a little bit of a depression. It'll kind of trade down a little bit because the fluff is gone. Why get involved in the stock? It's just not that interesting anymore. Well, then what oftentimes will happen, and people say, all right, wow, that was a good run. We just made some money. Then they'll say, wait a second, that was a great stock. The reason why they had to split their stock is because they went so high to begin with. Let's go ahead and let's get back involved with that stock, and it very well may resume its upward trend. All right? So those are the 5 key points of a stock split. Now, let's review that again. The yellow arrow right over here. Again, that's prior to the announcement. That is probably the one that I like. Again, the lowest maintenance. And I'll show you how I trade this. All right, in just a second. If you are very, 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 very quick, you can play the announcement. I am not that quick. I don't watch the screen that much. I would then probably encourage you to not play that announcement run. Very volatile. When it goes all the way up here to this yellow arrow and then comes right back down, kind of a little bit of a depression right over here till the pre-split run. Now this, you can tell a pre-split run by the volume of the stock. A volume is kind of the tip-off. It's going to let you know what's coming next. Okay? So the volume may be building, and then because we know there's a split date in the future, that's what's happening. Big institutions are getting involved. And then sure enough, we have the split date right over there, the split date. This little yellow arrow right over here, the post-split depression, and then it may continue. Now, I don't know about you folks. That can happen over a number of months, a number of weeks. That sounds like a lot of work sometimes to me. I got to be kind of honest here with you folks. Inherently, are we all lazy? I don't know. I would say we are. All right? We all really are. I may call it something else called maybe efficiency is what I really call it, right? But you know what? I'm all about doing everything that I'm doing in less time. I'm all about that. In fact, I've hired very, very expensive coaches to help me begin with the end in mind. My goal is not to work. My goal is to retire. So I hire people who are experts in efficiency, and I say, I want to work, but I want to take off, 3 to 5 months a year and still make excessive cash flow. Well, how do you do that? It's doable. You just have to begin with the end in mind, okay? So here is a low-maintenance way to take advantage of the split run. Watch. Ladies and gentlemen, that red line, if you were to control a stock for instead of 1 month or 2 months, but you control it up until the next January, what is the name, class, I'll ask you this, what's the name of the option that controls a stock for at least 7 months, expires in the upcoming January? Probably it's called a what? A leap. Yeah, so you can get in and out and in and out. A lower maintenance way to trade this is just by a leap. Follow the criteria that I gave you already. Having the delta of 90 or higher, usually buy 1 to 2 strike prices in the money in order to go ahead and get that delta. All right? And that's how you can go ahead and utilize this strategy. That is my favorite way to play the stock splits. Now that said, one way to go ahead and sell this, now think about this, since you understand a little bit more about volatility, I'm kind of having some fun here. If you buy a leap that's undervalued, think about this, right? Undervalued, all right? And you get you bought it correctly, and you're a part of the split run, it's called. Then all of a sudden the split is announced, and the stock then pops up from that euphoria. That option market maker, when he puts in volatility, he pumps in that volatility. He's pumping it in to the whole option chain. Usually calls and puts. He can actually do it either or, but in this case, it'll be mainly bullish, so he'll mainly make the calls very, very expensive. Also making your call expensive. An expensive call, would that be maybe a good time to sell? All right? That's what we're thinking. Long term, that's why everything everything relates to one another. We buy the underpriced option, and then we sell the overpriced option. Covered calls. Let me kind of go back. Let me review a little bit. Covered calls. We buy, ideally, the underpriced stock, bounces off the moving average, and then we see the stock rising up a little bit, it's starting to tip over a little bit, and then we see the options are very expensive. Perfect time to sell them, okay? So we would buy the stock when it's undervalued, and we'd sell the overvalued calls, okay? So that's a little bit about stock splits and kind of marrying that together with our over and undervaluation and how that relates to our historical or our past volatility as well as our future or implied volatility. Yes, you can access stock split calendars and stock split websites. Calendars may look a lot like this. This is Yahoo Finance, and this is where you can kind of see we have the payable date and the X date. The company, maybe you've heard of JetBlue Airways or I haven't heard, Group Health, Accredo Health I've heard of. There's the stock symbol right over there. Is it optionable? Only a few of them are. Yes, yes, no, no, no. The ratio, 3 for 2, 2 for 1, 5 for 4, 3 for 2, 3 for 2, and 3 for 2. Folks, the only one that I'd really be interested in that list would be the 2 for 1. Over here, here's the announced dates, and then you can actually have your own calendar over here. Well, let's take a look. Let's take a look at this one right over here, since it's optionable. This stock right over here, Accredo Health, on November 4th, announced a stock split. They announced that right over here, let's scroll over here, anybody who owned the stock that it would be payable, your extra share, since that was a two for 1, is that right? I'm sorry, I can't see. There we go. It's actually a 3 for 2. Is as soon as you owned 2 shares, you would get a third share. You get 3 shares for every 2 that you own. That's payable on December 2nd, right over here where it says December 2nd. And then the X date, that's when you see the shares in your account. The X date is the first day that it trades at its post-split price. So that's basically how it works. Also, by the way, you'll notice if you own stocks that have stock splits that occur with your stocks, you'll notice oftentimes that the stock split, what will happen is that the scale will change. The scale on the left-hand side or the right-hand side of the chart will change. That stock, like mine that I just did, that was $130 a share. Now it doesn't even look like it was ever $130 because overnight that scale changed to $40. Well, that's all it did. So it just accommodated everything. Instead of looking like the stock went like this and stock split, no, it'll look like and then it'll just change the scale. So it'll look like it's a continuous movement, which benefits us for our technical analysis needs. So that's generally what it'll look like. So let's review. Stock splits work best in a bullish market. Only play stocks with good volume. Good volume. If you notice a stock split on a very, very small company, I would encourage you to stay away. Email your instructor or call our hotline if you wish, but it's, we're really looking for good volume there. Stick with the big companies. If you notice a smaller company is splitting their stock, it's not going to be that bullish. It's probably not going to get the attention of the big money. I would discourage you there. Stay with the big money, the ones that you know. Stay in the money for short-term options. Stay in the money for short-term options. So if you're going ahead and you're going to work a stock split on a short-term basis, and instead of using a leap, you're going to use a short-term option, I'm going to encourage you to stay in the money. Why would you want to stay in the money for a short-term option? Several reasons. Number one, a short-term option that is deep in the money, maybe 1, 2, or even 3 strike prices, is going to have a better delta. It's going to move more appropriately when the stock jumps up. That's what we're looking for. Also, since you're actually taking less risk, let me rephrase that. With an in-the-money option, you're actually paying more money, you're taking more risk, and the option market maker is taking less risk. When he increases the volatility of all the options, since he's taking less risk with the in-the-money option, you're not going to feel the effects of the overpriced volatility as much. You're going to get a real nice delta. It'll be a real solid trade. In fact, you might want to target maybe a 40% gain on that. Depends on the stock, all right? Again, that would be forecasted from your charting the expected pattern, but that would be a good guess. Act quickly on announcements or don't play. I'm probably going to encourage you closer to the don't play them. Short-term traders take profits on announcement runs and on the split date. Again, so when the announcement run happens, the big money, the smart money, they don't buy at that point. That's when they're selling. All right? You too, I kind of went over that, is you sell the overpriced option, not the inexpensive one, the overpriced one. Watch other stocks in the same industry group for splits. This is pretty much a non-event right now, but it very well may happen in the future. When Dell Computer split, Gateway and Hewlett-Packard and Compaq split. I'm even dating myself talking about these examples, right? What was it, Delta? Yeah, Delta Airlines split. Not JetBlue, a couple others. I think United split as well. All right, American split. Same thing, in IBM, semiconductors, Intel splits, and we have a few of the other SanDisk, and some of the others will split, okay? They sometimes will happen in sympathy with one another. Let me go over that language because we use this in our newsletter. In sympathy with one another. So for example, good news on Dell Computer goes up, Hewlett-Packard will go up in sympathy. Which means in sympathy, it'll go up in, just by being in the same, ballpark, okay? Same thing with, let's say, a car maker. Let's use Ford Motor Company. If Ford Motor Company goes down on bad news, GM is going to feel that too, okay? It's just in sympathy move. A sympathy move will happen at the same time. Let's end here today with our 7th strategy. In fact, you know what? I'm feeling a little bit excited. I'm going to give you a bonus 25 strategies. Is that okay? No, I'm just kidding. Let's end with a 7th strategy right here today. You've doubled, tripled, quadrupled your knowledge, and it's even going to go further with your coaching. Exchange traded funds. Profit from forecasting the market or the industry trend. Let's talk about this. This is kind of our easier section here, folks, because now we're utilize the tools that we have available. We're utilizing stock splits. We're utilizing, calls and puts and covered calls. We know how to find stocks for covered calls. We know how to buy puts. We know we're comfortable with, maybe stock splits, leaps, one of my favorite strategies. And now let's talk a little bit about guessing and forecasting and taking advantage of the tools that we have now and the overall market trends. There's no need to identify individual stocks, just the overall direction of the market or an individual market sector. Exchange traded funds. These are called ETFs. Index options. So whether it's an ETF, an exchange traded fund, or an index option, each of these are, can very easily be used to kind of, take advantage of the overall marketplace by proxy. Again, by not using all of your cash, but just do it by proxy. Exchange traded fund resources. Now, this is in your book, but if you're taking notes at home, these are some really great sites after you watch these DVDs to go ahead and kind of take note of. If you are used to mutual fund investing, all right, then you're going to kind of be interested in this type of resource here, okay? Amex, that stands for the American Exchange. iShares, that's iShares, separate website for that. We'll kind of show you that. And Holders, the Merrill Lynch Holders is what they're called. Fantastic website to invest in overall kind of groups. In fact, I have an example of a couple of these. Use the market posture to spot opportunities. So are we bullish or bearish on the overall market? Are we going ahead and take a look at the VIX and the VXN? And also, what's your market forecast? What is the market forecast? Are you short-term bullish or are you short-term bearish? Can be done also with the index tracking stocks that offer options. There's about 30. The QQQs, called the triple Qs, or the cubes. That's C-U-B-E-S, cubes, it also is called. DIA, called the diamonds, et cetera, et cetera. There's several of these. Merrill Lynch Holders. The holders are a very, very savvy way to invest. A lower risk, because when you buy one share of a holder or something like that, it then controls the overall index or the indice. Right over here, we have the holders itself. We have the biotech holders. Take a look at these, folks. Let's take a look at this slide here. We have the biotech holders, broadband holders, business to business, et cetera, internet architecture, infrastructure, pharmaceuticals, software, telecom, wireless. Wireless right now, as we're filming these DVDs, have been pretty hot recently. All right, Motorola and Nextel have been in a fight for the components to even build these new phones. Humorously, I remember I have a phone that actually takes pictures. Have you ever heard of these phones? They're amazing. You take a picture and you can email it to somebody. I said that to one of my best friend, my dad, and I said, "Hey, Dad, I'm taking a picture of your grandson," and I emailed it to him. And he humorously said, "Email it to me from your phone? This wireless?" And I said, "How can you do that?" He said, "Son, as a matter of fact, I just took a picture with my shoe phone as well." Like the old Get Smart days or Dick Tracy, Just amazing, the technology. Fast forward 10 years, where the heck are we going to be with this technology? Well, if you notice, big money is heading into the industry group. We'll go ahead and pick up a holder. Pick up one of the wireless holders or the telecom holders, whatever. A great way to diversify, and there's options on all of these. Well, in fact, I would encourage you to go ahead and have one of your